Welcome to Accounting 202, Managerial Accounting at Kapiolani Community College. In this video, we'll delve deeply into chapters 21 and 26, which, even though they're widely separated, are closely related in many ways. Let's take a look at the original CVP or cost volume profit income statement that we looked at in chapters 19 and 20. Sales minus variable costs equals a contribution margin, and when you subtract fixed costs, you get operating income. Well, let's expand fixed costs to encompass two major types: direct fixed costs and indirect fixed costs. Direct fixed costs are the kind of costs that can be directly traced to each unit that you're looking at, such as a segment of a business. Indirect fixed costs are also known as common fixed costs, and they really cannot be traced to any one particular place. Among direct fixed costs, there are two major subtypes: controllable direct fixed costs, such as how many supervisors you have on a particular shift or how much you're going to spend on your weekly advertising, and committed fixed costs, such as how much is your rent. So these distinctions are important because we can use these subtotals listed here, controllable margin, segment margin, and of course the contribution margin, to make various kinds of short and moderate term decisions. If we're making short run decisions, the controllable margin's very helpful because this is what is truly under a line manager's direct control. If you're talking about moderate to long run decision making, then segment margin is probably a better measurement because the committed fixed costs can be influenced or changed over time. However, if you look at the operating income for an entire segment, it's really not useful for anybody except for the people at the very highest levels of management. And this is because it includes costs that you may or may not change as a result of any particular course of action. So if costs don't change, then they're not going to affect the outcome of a decision. That means they're irrelevant to decision making. So from a manager's standpoint, when you're talking about operating income for a segment, that has no power to influence or control or motivate the person who you're using it on, because that's beyond their power to control. So basically it's a useless thing to use for analysis purposes at the individual manager level. Incremental analysis is what we do in this chapter, and that looks at changes in amounts from various courses of action. So that's very, very broadly defined because we can look at all sorts of possible situations. And what do you want to look at? You want to look at the costs that are relevant, and the costs that are relevant are only those costs that will change. So the operative word here is change. If it doesn't change, it doesn't matter. And there are multiple life situations where there's decoy information or irrelevant information that you need to actually ignore in order to make the correct decision. So here's a format that I think can save you time if you try to adhere to it. If you look at things that are positive outcomes from a possible decision that we make, two major positive outcomes are we could either increase our revenue or we could decrease our costs. Negative possible outcomes as a result of a decision are that our revenue could decrease or our costs could increase. If you amass all of those various possibilities, stick them all together, and take the net of all of them, if the bottom number here is a positive number, then that means whatever the decision was that led to all of these possible changes that ended up being positive, you ought to go ahead and do it. However, if it came out negative, then you ought to not do it. Some types of incremental analysis: special order acceptance. If we have limited resources, you have to kind of consider that maybe you might not want to accept a special order because it may not be within your capability to provide it, or it might dislodge other valuable production. You take a look at the operating income from possible courses of action, and so accepting a special order means we may or may not want to do it depending on what it does to our income. A make or buy decision: if we increase our income because we are no longer making a part that we used in production, we're now currently buying it from outside, as long as the increase in income, which is really a decrease in costs from stopping production, is larger than the decrease in income, in other words, increase in cost from having to buy the part, then we should go ahead and buy it. If, however, that net amount is negative, then we should just keep making it. Sell or process further. This is heavily reliant on the idea of sunk costs. Sunk costs means costs that you've paid and you can never get back. So if we, for example, invested in a machine that turned out to be kind of a loser, or any other number of possible bad decisions, then we can't get our money back from those decisions. If we've generated production that's poor and needs to be reworked, we want to decide whether we want to rework it or just go ahead and sell it for scrap or whatever it will bring on the open market. So the operative factors here, are the things that you care about, are how much revenue will you make from processing it further. In other words, taking something that's not well made and remanufacturing it to make it meet standards, versus how much it's going to cost you to do that. If the net of those two is positive, then you would go ahead and try and fix the product and sell it as a good product. If, however, it's negative, then you would want to just go ahead and sell the thing for scrap right now, or whatever it is you can get out of it. Retain or replace equipment. The basic idea here is you're going to buy some new equipment to replace the old equipment, and that new equipment is going to bring you cost savings and other good things. However, it's going to cost you money to go ahead and buy it. Look at the cost savings from getting the new equipment, subtract the cost of purchasing the new equipment, and if the positives outweigh the negatives, go ahead and do it. If the negatives outweigh the positives, don't do it. One of the toughest problems in this chapter is the idea of calculating the change in operating income as a result of getting rid of a segment or a department of a business. A simple situation would look like this. Getting rid of this department or closing down this department will increase our income because it will reduce certain fixed costs. However, on the other side, the income will be decreased somewhat because we'll be giving up our contribution margin. If, however, the positives outweigh the negatives, then we should go ahead and do that and discontinue that segment. If, however, the negatives outweigh the positives, then we should not discontinue the segment. Now, if we're looking at cost over the long run, things that currently seem to be permanent may not be permanent when we consider long-term possible decisions. So let's take a look at doing a problem that involves keeping or eliminating a department. In this situation, we have the following data. The company or the division has sales of $178,000, variable cost of $142,400, and a positive contribution margin of $35,600. They have direct fixed costs of $25,000. That's both controllable and committed fixed costs. So they're direct to that particular segment. That means if this segment goes away, you won't have those fixed costs. Therefore, if this segment goes away, you won't have this segment margin. So that means everything all the way down to the segment margin is going to be gone if you get rid of this department or segment. Indirect fixed costs, however, someone has to study them and decide whether or not they'll even change at all, and if they will change, by how much. So just looking at the bottom line here of the net loss cannot be used to tell you how much your income will go up or down by, because you have to take into account possible changes in the indirect fixed costs. You can assume all of the direct fixed costs will go away. That means not just the contribution margin, but the segment margin itself would go away. So let's say that the scenario says eliminating this division will save 10% of the indirect fixed costs. Somebody did a study and determined that. Well, what that means is that we want to take a look at the change in income from eliminating this division. So first of all, our segment margin is going to go away. That's a bad thing. The segment margin is currently helping us cover those indirect fixed costs. And according to the problem data, eliminating this division would help us get rid of 10% of the indirect fixed costs. How much is that? That's about $4,500. Now, if you look at it, you can kind of see what's coming down the road. The change in our income as a result of getting rid of them would be a negative $6,100. So should we go ahead and do that? No. If we were to eliminate them, our income would go down by $6,100, so do not eliminate them. Keep them. Suppose, however, getting rid of that division would save 70% of our indirect fixed costs. Well, we want to look at, again, the change in the income from eliminating the division. We'll get rid of our segment margin, that's 10,600 negative, and our indirect fixed costs will drop by 70%. Now the indirect costs are $45,000. 70% of that is $31,500. Therefore, the change in income would be $20,900 positive. Should we do something that's going to make our income go up by $20,000? Yes, we definitely should. What is that something? Getting rid of that division. So therefore, we would eliminate them and our net income would increase by the $20,000 figure. So this is an example of keeping or eliminating a department, incremental analysis. Capital budgeting involves the same kind of thinking as incremental analysis. However, we look at alternative courses of action with regard to investing in long-lived assets. Typically, we're talking about, do we want to purchase this piece of equipment or not? And so we use kind of some of the same kind of techniques that we looked at right over here with make or buy, retain or replace equipment, but a little bit more deep. One of the first alternative ways of evaluating a possible project is we can do what's called a payback period. The payback period looks at how long it is until we get our initial cash investment back. So we look at the initial cost, and then we look at our annual cash inflows from that project, and that'll tell us our payback period in years. So if it's a short payback period, that's generally better than a long payback period. Annual rate of return on average investment looks at investments of various sizes and kind of puts them on the same sort of footing and turns them into a percentage number instead of a dollar figure or a year figure. So to do this, you take your annual net income, which is sales or revenue minus expenses, including expenses like depreciation, which don't involve cash. And then you take the cost of the project plus its estimated salvage value at the end of the project, and then divide that by 2. That'll be your average investment. So annual net income divided by average investment gives you your annual rate of return. One of the gnarliest type of analyses in capital budgeting is discounted cash flow. Discounted cash flow looks at what you could be doing with your money if you weren't investing in this thing that you're looking at. So for example, investors who buy bonds wouldn't want to buy a bond that gives a low interest rate, so they'll only pay a discounted rate for that bond. Conversely, if a bond pays a better than normal interest rate, then investors will tend to purchase that bond at a premium because they can't get that elsewhere. So the bond price changes to compensate the investor for missed opportunities or extra opportunities. So present value looks at today's value of tomorrow's money. So this is kind of a deep idea, so you don't really expect you to get a deep understanding of it right now. You just want to kind of get good at the computations. So let's say we have what we call the discount rate, or the cost of capital, or the incremental interest rate, or any other number of terms, but that means the percentage that we need or want to get on most of our investments. Or alternatively, if we had to borrow money, how much we would have, what interest rate we'd have to borrow it at. So the first thing you do is you look at the present value tables, and you may have to look at one table or another depending on the kind of way you've received your data. If you look at the present value of a lump sum, or $1, that's in Appendix G, Table 3, page G8. And so you take your dollar amount and you find the appropriate factor, which we'll show you in a minute, and multiply that dollar amount by the present value factor, and that'll tell you today's value of tomorrow's dollar. However, if you're going to get the same dollar amount each year after year, then you can go to the annuity table, which is Table 4, and take your $1 amount out of the many multiples you're going to be getting of the same exact amount, and then multiply that one-time dollar amount times the PV factor. The PV factor has the number of years built into it because you're going to find the appropriate factor for the number of years you're talking about. So net present value then takes today's value of tomorrow's money and discounts it to a lower amount, and subtracts out the current costs or current outlays that you have to make, and the net of the two. If it's positive, it's a good project. It exceeds your required rate of return or exceeds your incremental cost of borrowing or your discount rate or whatever term is given with the percentage attached to it, and then that would be a good project. If it does not come out positive, then it's not a good project. So how do you do it? You take the present value of the future cash inflows, subtract the present value of the current cash, typically now current cash outflows, and then you get net present value. So most times you don't have to do anything with today's cash outflow. You just subtract the original given dollar amount. Now, the profitability index takes a look at this net present value and then determines some kind of a comparison between it and other possible projects being evaluated using net present value. Let's take a look at a net present value problem. This is a situation where our cost of capital or our discount rate is 10%. Our initial investment's $90,000, and we have two competing projects. Project 1, which is going to last for 4 years and gives $27,000 cash inflow per year every year for 4 years. So that's about $108,000, I guess, over that period of time. Wow, it's $18,000 extra. Sounds great. Go for it. Maybe not. Project 2 is going to give us $40,000 in year 1, $40,000 in year 2, and then drop to $20,000 and then finally $8,000 in year 4. Both projects have a $90,000 cost. Which one should we take, if either? Well, we want to earn a 10% rate of return, or our cost of capital, or our discount rate, or our alternative investments that we could invest in are looking at a 10% rate. So if we take a look at these factors and we do the initial investment of $90,000, we would go to table G4 and look up the factor that goes with 10% column, 4 periods. That factor then would be applied to the $27,000 to get us the discounted cash value of tomorrow's cash inflows, and then we'd subtract the $90,000, and positive, go for it, negative, don't go for it. Project 2, however, you can't do that level cash flow with the one factor. You have to look up the factor for period 1, then the factor for period 2, then 3, then 4. And each of those is a different factor, but they're all from the 10% column. So when you put it all together, you would then get the present value of all of these items here, and then again go ahead and subtract the $90,000. So doing that for all of these guys puts it like this. For project 1, 27,000, I went to the table 4, I found the PV factor for 4 periods, 10% row column, and the present value of tomorrow's cash inflows is only 85,000. We got to pay 90,000 now, so that means our net present value is negative. I wouldn't go for this project then. It doesn't meet our 10% required return. However, project 2 has a big upfront loading of 40,000 for the first 2 years. The PV factor for one period, $1 amount received in 1 year, is this 9 number. The present value for $1 received in 2 years is this 8 number. The present value for $1 received in 3 years is the 75, and 4 years this 0.68. Okay. When you multiply these out, the present value of these cash amounts received in the future comes out to 89,000. Unfortunately, our initial investment is 90,000, so this project is just barely not acceptable. If, for example, 10% was determined to be a little bit too high a rate, or maybe the return might be like slightly more loaded towards the front, maybe 45,000 in year 1 and 2 and less in year 3, then the project might start looking positive. But it all depends on the facts and circumstances of the situation. Last thing we want to look at, internal rate of return. Internal rate of return is the rate of return that makes the present value of this project equal to its cost. So what percent would make the present value come out to the present value of the cash inflows come out to the cash outlay? Well, first thing is get the internal rate of return factor, which, if you've noticed, this guy looks kind of familiar. This is our cash payback period. And we're going to use that as our internal rate of return factor. So that means we find that factor, and then we go to this table here, and for the number of years we're talking about, so say 7 years, and we find the factor that's closest to the payback period number that we got. So let's say we have a project that has a payback period of about 5, and it's going to last 7 years. If I were to look at this table here and I found a payback period of 5 and it was a 7-year project, I would go on my 7-year row here looking for a factor that's very close to 5. And when I arrive at it, I go, ooh, that one's really close to 5 right there. That means that this project is expected to have a 9% internal rate of return. Thanks for listening. Hope this helps.